Hey everyone, in today's video, I'm going to go through my entire $255,000 Wealthsimple stock portfolio. We're going to go through every single stock that I have in this portfolio and review my thoughts about these positions. Also going to do a total portfolio overview in terms of how the portfolio has been doing over the last year and all time since I started this account. So I hope you guys like this video. If you do, be sure to give this video a big thumbs up. It really does help with the channel. Okay, so my portfolio here is broken up into the Canadian side of it, which is about 150,000 Canadian dollars, and then about 80,000 US dollars. Overall, you can see here the US side's done a lot better, up about 20% all time, whereas the Canadian side here is still doing okay. All time, we're up about 6%, but not as high as the US side. And there's good reason for that as we go into each of the stock positions. That'll make it obvious. But when looking at the 6%, you can see it actually just came recently. I was up a good amount, 5, 6, 7, 8% over the last year or so. And then I lost it all in the summer as interest rates kept going up. Lots of my REITs and my utilities were getting hammered. And just recently, they've rebounded really nicely here. And you can see that gain between the green and the gray line expand again near the end there. So let's start with going into some of these positions in my Canadian account. First position here, Allied Properties. This is an office REIT that operates in Canada. You can see here, this has not been a great performer for me. In the last 5 years, down 55% here. The interesting thing about this office REIT is their funds from operations or earnings has actually been pretty flat to slightly up over the last number of years. They do about $2.20 of funds from operations. They used to trade at over a 20 times multiple just because they operated in downtown Toronto and lots of other very dense, highly attractive office spaces. But now they're trading at under 10 times earnings here. And they haven't cut the dividend, still paying a 9% dividend yield. And they mentioned that they think they're going to increase it again next year. So the fundamentals of this business, while they do have some hardships ahead of them, seem to be holding together decently. But the value of the underlying assets have just gotten hit here. So this isn't one I'm really buying more of, but I do have about $5,000 in this one. No plans to move out of it. Next stock here, A&W Royalty Corp. So A&W Royalty Income Fund here in the last year has also had a bit of a hard time, down 13%. This one yields about 6% that I get paid out on a monthly basis, which I really like. And this is very similar to some of the other royalty companies that I have in this portfolio that I'll talk to later. But I really do like royalty fund structure. I don't have to deal with debt management, don't have to deal with inflation causing costs to go up in terms of the expense lines, because all of this is royalty on top line sales coming into my pocket every month. If anything, as costs go up, food inflation, etc., that should increase menu prices. And as long as menu units or units of people going in and eating lunch at A&W or dinner don't go down dramatically, inflation actually turns into a help for the earnings and the dividend on this one. So that paired with the fact that food service is relatively defensive of a space, I still really like this one. I built out a pretty big position between this account here where I have about $12,000 and also another couple positions in my TFSA and RSP. So this is one that I actually have a pretty big position in, so not buying more of, but I do like it here at over a 6% dividend yield. Bank of Nova Scotia here has been one that currently is paying a dividend yield of 6.6%. So lots of these have very high dividend yields. I am primarily a dividend investor, even though I divert from that in some instances, which you'll see later. But 6.6% yield, trading at under 10 times earnings here. So I do like the banks too. I think long-term the banks will continue to do well. CapREIT, this is a residential REIT in Canada, so they own lots of apartment buildings, stuff like that. Aside then, or alternatively to Allied, they trade at a pretty rich valuation. I think they're trading at about 20 times. And that's still down from historically. They were actually trading closer to 25 times, believe it or not. But obviously interest rates will impact the valuation of these companies that trade on these kinds of multiples, especially when they have a lot of debt on their balance sheet. So this one's currently paying a dividend yield of about 3%, $8.4 billion market cap. I believe they're one of the largest landlords in Canada to individual tenants. Cash is an ETF that I actually hold a good chunk of spare cash in. You see here $15,000 in this one, and essentially how this one works is it just accrues high interest savings throughout the month and then pays me a dividend at the end of each month. So it's the same as having a GIC, a variable GIC for the most part. I've been making about 5% give or take on this ETF that gets paid out monthly. It just gives me a lot more flexibility that I like. I can take money out any day I want. I don't even lose the interest for that month because I'll get it in the share price. So I think it's a pretty effective way to have a big cash position in these times with higher inflation and just making sure I'm not losing that money to inflation. CN Railway here, $165. This is one I've owned for a long time across many accounts, up 64% in the last 5 years. You can see here I have a pretty good position in this account too, about $16,000. This company is one of the best companies in the market, in my opinion. They have a great moat. No one's really buying new or building new rails across North America. It would just be impractical to execute that. And in addition to that, lots of the markets that they hit as they go kind of east to west across Canada and then south through the US, they are the only rail in the area for lots of farmers and stuff like that. So they have tons of pricing power. They obviously have to be responsible with it. And there's lots of regulatory considerations too. But they're just really well positioned to continue that recurring flow of earnings and traffic. They also own lots of ports in Vancouver and other areas of North America. So as imports and exports increase, as the North American economy expands, they'll continue to grow. They buy back lots of shares. They increase their dividend every year, and they continue to invest in making their tracks more efficient and expansion projects as well. So I do really like this one for the long term. I can't really see a world with the North American economy continuing to grow and pump out productivity where CN Rail does not prosper in a really great way. Next one here, we got Canadian Utility. Canadian Utility, this is one of the only dividend kings in Canada, actually. They've increased their dividend over 50 straight years. Starting yield, though, is 5.7%. So the last handful of years, they've just been increasing it 1%, 1 cent, stuff like that to keep the streak going. But they've fallen on some harder times. Obviously, a company with lots of debt because they're in the utility space. So the spike in interest rate definitely hasn't helped them. So we'll see, hopefully, as things kind of soften out a bit in 2024, if they can kind of get more on the offensive in growth mode as well. Even though it says Canadian Utilities, they actually own a lot of assets outside of Canada as well. So if you're interested in kind of a diverse utility play with a nice starting yield, maybe this is one you may want to take a look at. In the last 5 years, you can see here, the stock's pretty much gone nowhere, but you have gotten that nice dividend yield along the way. Going to start going through some of these ones faster. Dream Industrial, I just added this one. This is the most recent stock that I added. I just did my last video on it. I only picked up 10 shares for now. I'm looking to make this into a much bigger position. I hate when they jump right after I buy them because I want to average in here. But you can see here, unlike lots of the other REIT spaces or REIT sectors, industrial real estate is up really nicely. Dream Industrial is up over 20% in the last year. They also acquired Summit Industrial REIT, which was another REIT that was traded on the TSX prior. But this is just great real estate, in my opinion. Unlike some concerns in office real estate or retail real estate, industrial real estate has a lot of tailwinds. Lots of companies need these distribution centers and light industrial centers on the outskirts of big towns like Toronto, Montreal. They also have exposure to Spain, France, Germany, etc. in Europe. In order to get e-commerce goods that are bought online or fulfilled from online purchases to these huge urban markets. So this is a company that owns a lot of assets that I think are in high demand. And no matter what happens medium term with interest rates, I think that value will continue to get realized. I'm also getting a nice 5% starting dividend on this one as well. Okay, Fortis, similar to Canadian Utilities where they continue to increase the dividend every year, but at a faster clip. So 4.2% dividend yield on this utility, and they increased their dividend about 6% year in, year out. So you're getting a bit of a shorter smaller starting yield, but a better growth rate. So it really depends on your investment horizon and what your investing goals are. But this utility owns assets across Canada, across the US, also the Caribbean, and they have largely regulated fees. So it's very stable. Their earnings never really surprise anyone, but they do get impacted a lot with interest rates going up and down just because they're so stable. You're pretty much buying into a yield here. So that's the only watch out when buying Fortis. Long term, though, the company's done pretty decently, up almost 20% in the last 5 years. If I add their 4 or 5% dividend to that, they're probably in line with the market there. Okay, continuing on to some of my cover call ETFs. So I'm going to fly by these. These are ETFs I just have primarily for income now. They tend to not be the best performers long term, but I really like having that monthly income to reinvest in other areas of my portfolio. This one here, HDIF, in the last year, we're up about 2%, but I've gotten a 10% distribution yield. And this is just a collection of all of Harvest's covered call ETFs put into one ETF. And I think they slap 25-30% leverage on it as well, just to maximize the cover call income to get to that 10% yield. So obviously, up 2%, I'll take anything that's up on a cover call ETF that's yielding me 10%. So short term, that one's done well. This is another covered call ETF on global utility companies. So think, telecom, pipelines, that kind of jazz in terms of what's inside this. Down 5% in the last year, but I've gotten a 8.5% dividend yield. So I've made up a couple percentage points of total return gain on that one. And then another one that is a place I park cash is HSave. This one, unlike the other ETF I was showing you where it pays you out every month, that was ticker cash, this one actually accumulates the gains over time. So you can see it just reinvests the high interest into the ETF. Just a bit of a different tax play depending on where you hold these ETFs. If it's a TFSA, RSP, or an unregistered account, this may be one that you may want to consider. Okay, continuing down, JWell. Jameson's one that I really liked earlier in the year. You can see here it's down 15% on the year. I actually bought in the mid-20s here, averaged down a bit as it went down. So looking at my position here, I have about 125 shares. I'm up over 20%. But I never really got to build out a huge position. Still in it for under $4,000. So that's one thing here is now we're over $30, closer to a high teens around an 18, 19 price to earnings. I was buying in when it's closer to 15 times. So the risk has adjusted a bit in terms of the risk reward profile. This is one that at these levels, I still don't think it's a bad buy, but I'm not really eager to load up the boat on it. So this is one that I'm just kind of holding, seeing where it goes. If it goes up a lot more, I may trade out of it, take those gains and invest in some other areas in my portfolio I'm looking to grow. But if it goes down, may end up building out that portfolio. Just kind of in no man's land here where I don't think it's a bad price, obviously not a bad company, but it's definitely not the fantastic price it was when it was trading at $21, $22 a share just 5 or 6 weeks ago. Overall, company pays a 2.4% dividend yield. They've been increasing that dividend yield every single year. They have a really nice revenue growth CAGR as well. And I think long term, while it may have got bid up a bit during the pandemic, the fundamentals of this company are really strong. They have a really developed business in Canada. They just made a nice acquisition in the US. They're expanding their business in China and in Europe. So lots of things going for Jameson Wellness here. Next, we got KEG Royalty. So exact same thoughts on this one as A&W, with the only exception being this one I acknowledge is not as defensive as a play. It's a sit-down restaurant. It's a bit more of a luxury place versus a fast food joint. But I do just like the structural economics of revenue or royalty on top-line revenue flowing through to me every month. Just given the increased risk on this one, it's traded down about 15% in the last year as the fears of the economy have kind of hit parts of the market. 8.5% starting dividend yield though. So I'm getting an extra 2.5% versus A&W on this royalty fund in terms of the valuation of the income. Continuing on here, another cover call ETF, very similar to the other ones we talked about, but this one is ticker LIFE, which is a global healthcare ETF. down 5% in the last year, so similar to my global utilities ETF, but I've gotten that 9% dividend yield, so I haven't done too terribly on it overall. PSA is just another version of cash. I like to split up my cash across a couple of accounts just because it's pretty big dollar amount. So have another $5,000 in this one here. And then continuing through some of my other, or probably my worst performing stock I own in my entire account is Northwest Healthcare. So you can see here in the last year, down 50%. They announced a reorganization a few months ago where they cut the dividend by like 60-70%, because they were paying out like a 12% yield at these levels. Showed where they were going to focus their efforts, where they were going to focus their business. So we'll see where that pans out. I know they were talking about like a medium-term target. They wouldn't give a year of targeting like $1 per share in funds from operations. So obviously, if they can actually pull that off, stock's pretty cheap. But I'm just kind of waiting and seeing. I'm not adding any more to this stock right now. I'm down pretty big on it already. I'm just collecting my dividend yield. Looking at the last 5 years, you can see it was actually a pretty stable REIT, especially through the pandemic. Lots of the other REITs were fluctuating hugely, and it's really just been their performance in the last couple years as they've had some joint ventures go bad. They've had obviously the interest rate situation, and some of the areas of the world they're exposed to have had some challenges. But overall, I like the idea of this healthcare REIT. It just, has been facing a bunch of wounds or death by 1,000 cuts in the last year or so. So I'm still holding on, still collecting my dividend income, but not one that I'm adding to at this point until it's more clear how they're going to come out of it. One of my bigger gains in my Canadian portfolio, Restaurant Brands International here at $100 a share. You can see here, they've gone on a bit of a rocky ride, went all the way up to $100 a share, then back down to the 80s, back up to 100. They hired the old Domino CEO to be their chairman, and he just did a phenomenal job of step-changing franchisee economics, expanding the model globally to Domino's being the largest pizza brand in the world. So there's lots of excitement that he can do the same for lots of QSR restaurants, which are predominantly North American operated today. Currently, this one pays about a 3% dividend yield, and I believe they trade at a slightly lower valuation on multiple versus like Yum Brands or McDonald's or something like that. And then for me as a Canadian investor, I have the benefit of collecting my dividends in Canadian dollars, so I don't have to pay withholding tax or anything else, FX dynamics on this one as well, which I like. Okay, going into the final stretch of the Canadian stocks here. Rogers Communication. This one I actually just started buying a bit more recently, but it just completely took off when I started buying more. So I didn't get into it too much. Was buying in the low 50s, adding to my position, up 20% since then. But they're expected to do close to $5 of EPS next year. So they're trading at around 13 times next year's earnings here. Definitely not bad in my opinion. I'm up about 7% now, and it pays a 3.3% starting yield. In addition to obviously the cable business that they just doubled with the acquisition of Shaw, opportunities to drive more profitability through synergies there. They also have the largest data business in Canada. Lots of people use Rogers for their phone plan in Canada, and that's a very high margin business. And then lastly, they have lots of very good media assets. Obviously own the entire Toronto Blue Jays, also own a good chunk of Maple Leaf Sports Entertainment, which owns the Raptors and the Leafs. So they benefit from those relationships, just how they feed their media division and their cable divisions as well as just lots of underlying value in owning sports teams. Like the Toronto Blue Jays are probably worth $1 to $2 billion just on their own. And the company here is worth 30. So that alone is worth 6-7% of the overall stock value here. Going down a bit, we got RioCan. RioCan's one of my biggest holdings across all my accounts. It's not very big in this account, just have about $500. You can see in the last year, RioCan's been trending down with the broader REIT space. Currently expected to do about $1.80 funds from operations. So trading just over 10 times earnings here, getting a nice 6% dividend yield, give or take 5.9%. And at 10 times, given the pipeline they have coming, they also have some residential apartments that they rent out. I just think it's a fair place to be buying and getting a 6% yield to wait. TD Bank, another one of my big positions across all my accounts. And this account, not too bad at about $8,500, has had one heck of a rocky year. So was at 95 bucks a share to start the year. With the regional bank crisis, went down into the 70s. Lots of puts and calls since then. Currently sitting at about $84, which is about 10 times next year's earnings. This is one that I'm not buying aggressively, but I nibble a couple shares here, a couple shares there on TD Bank. It's my favorite out of all the Canadian banks. I like how big of a presence they have on the commercial side of their bank. I think that really makes their earnings a lot less volatile than like RBC or Scotiabank or some of these other banks. So I think it's a stable bank. You're getting it at 10 times earnings. They pay a 5% dividend yield. They're buying back shares. They're making acquisitions and stuff like that to continue to grow aside from their organic growth. So I think the valuations on the Canadian banks overall are pretty attractive, and I own a handful of them, but TD is probably my favorite one. XIC, just for diversification, thought it would make sense to own the entire TSX. So this is just a total TSX market ETF here. Has a management fee of only about 5 basis points. You can see it's done pretty well over the last number of years. It's been flat the last year or so. So I think I got into it at a bit of a low point, just 20 shares here, up 5%. Wouldn't mind building this into a bigger part of the portfolio just to be a bit less reliant on individual stock fluctuations. And then one thing I've been trying to achieve this year is just broader global diversification in my account. Obviously, lots of Canadian US investors are very skewed or overdeveloped in their Canadian and US exposure. So this is a BMO International Dividend ETF, holds blue chip dividend stocks, mostly in Europe, also in Japan, Australia, some of those types of markets. So overall, up about 14% on this one here. I think that's because I was buying some stocks near the beginning of the issues that were going on in Europe currently. So I've been averaging up on it since then, but since my cost basis was around $16 down there, I still am up overall about 14%. Get about a 4.3% dividend yield on this one, and it's actually a pretty big position, about $10,000 there. Okay, so those are my Canadian stocks. You can see on the right-hand side here just overall how up and down I am on each of these names. But what's important to note is almost every single one, or maybe every single one of these stocks, is actually a dividend stock. Lots of them 6, 7, 8, 9% dividends if I include the cover call ETF. So while lots of those stocks were down, overall I've made about $8,000 net on them in the last 2 to 3 years. Going over to the US side here. So US, much different story. It's been a huge growth year for my US portfolio, up about 20%. And when I look at when I was even, at the beginning of this year, I was actually down on this account. So this entire 20% gain came in 2023. It's where lots of my portfolio growth has come from. So as you're going to see, lots of it's driven by a handful of big tech stocks that I do own in this account. Starting with Google here. Google, if I go in the last year, up 60%. I have 63 shares. I've traded in and out a couple of shares, but overall about $9,000, and I'm up about 22% on them. I think Google is a great business. Obviously, a lot of ambiguity on like what's going to happen with AI and what's going to happen in the future with technology. But just as it sits today, they're just such a cash cow, have so much cash on the side as well. And I think their search business and other advertising businesses they have like YouTube just will continue to grow and expand until disrupted. So watching closely to see what plays out here, but this is definitely one of my bigger positions across my accounts as well. Coca-Cola, this was a new stock that I bought, same efforts as that ZDI ETF. I just wanted more global diversification, and Coca-Cola does have a really big presence in global markets. That paired with the fact that it was actually a down year for Coca-Cola in general and lots of the CPG companies made me just buy this one a bit more aggressively. So I built up a $13,000 position here, overall down like 1 or 2%. Gets paid I get paid a 3.1% dividend yield. And Coca-Cola is a dividend king. So they actually increase their dividend every single year for over 50 years. So I feel pretty confident that I'll continue to get that annual raise, whether it's small or big, not sure, depends on the year. But I think they have the model figured out to continue to drive shareholder value and returns of shareholder value. McDonald's here. McDonald's I'm actually up quite a bit on, 26% up here in the last year. up about 9%. So much different story than Coca-Cola on this one. But similar story in terms of why I like to own it. Good global diversification. Lots of people are concerned just about the healthiness of McDonald's and will it become extinct because it's not healthy enough. These companies have such great footprints that I firmly believe if consumer trends really did change, their same store sales were going down because of health issues, they would pivot their menu and they would act accordingly before anyone can meaningfully dent their network or replace McDonald's with a healthier alternative. So I just think the network effect and the moat they've built out around the world and with the brand is going to be really hard to dethrone them on. I think they're going to be in line or ahead of any major trends that come. I'm sure they do consumer research. They're a multi-$100 billion company. So as people, may want less of one thing or another, they'll pivot to what they want in line of when they know they want it, or maybe even before. So I don't really get too concerned over that. My biggest gain position on a percent basis is Meta. You can see here, Meta's up 200% in the last year. I'm up about 240% on this one. So even though I'm only at about $1,000 in the company, I'm up about $2,800 US, which is notable in the grand scheme of my portfolio. We can talk about Meta all day. I think lots of you guys probably know exactly what's gone on there, but that's one that it's just hard for me to sell in this account at this point with that kind of gain on. So I just hold it. Microsoft as well, off of the AI craze, up 50% on that holding. Also get a little dividend. It's down to under 1%, but they increase it pretty nicely each year. You can see here the stocks just kind of took off over the last year as big techs roared, and as their AI ownership in OpenAI and just roll out to all of their Office 365 tools and more hype around that's kind of blown up. They've gone back to all-time highs. Realty income. This is one, once again, more of a diversification one. Don't have any REITs or real estate ownership in the US, paired with the fact it was a down year, thought it was a good year to own realty income or start buying in. And as it trended down, I continued to buy. So over 10,000 US in this one, down about 3% all time, getting about a 5.5% dividend yield on this one here. So like this position, probably won't make it too much bigger, probably just get to like 200 shares and then take that monthly dividend every month in this account to invest in other things. P&G there, $145 a share, pretty similar story to Coke, McDonald's, so we don't have to go over it again. S&P Global here, this was a new one too. I really liked just the fintech space. I own Visa, which we'll get to in a minute. Thought S&P Global would be a nice complementary add to that. The thing is, this stock has just taken off, so up 31% in the last year. I'm up 16% even after averaging up a number of times. So I have about $6,500 in this one. Wish I got the opportunity to build it up to a $10,000, $15,000 position before it blew up. So this is one I'm just kind of sitting on, seeing if it'll come back down, it'll correct itself a bit in terms of the PE, which is like in the low 30s here. So really hard to buy in at these levels. We'll wait a couple more quarters of earnings to see how things play out, but I'm just sitting on my hands now on S&P Global. AT&T is one that is currently paying out a 6.7% dividend yield, and they're just still swimming in free cash flow despite the debt position they have being pretty large and something they definitely should be managing. I like how they continue to the operationally spin out a lot of free cash flow. They can manage that debt. They can pay the dividend. They have a lot more money to invest in future growth. I would just aggressively be paying down debt if I was AT&T, and I wish they would do that a bit more aggressively with their free cash flow, even if it meant having a bit of a lower dividend, just to sustain the business a bit better position them to invest in the future and opportunities. But this is one where trading at $117 billion, they're going to do $16 billion of free cash flow this year. So they're trading at like a 7-8 times free cash flow multiple, which I just think from a net present value point of view is too cheap for this company that still has a lot of solid businesses, even though maybe cable in itself is starting to crumble a bit. Visa is at $260 a share here. This was actually going into 2023. I did a big video, one of my first videos on the channel, on how Visa was the stock that I wanted to add the most to and make into a huge position for 2023 because I thought it was going to go up a lot. And I was kind of right, up 26% in the last year here, unfortunately, started going up pretty quickly. So I did build up a bit of a position here, up 22% on it. Would have liked to make it even larger though. Visa does pay a slight dividend, 0.7%, but they're really known for allocating their capital to share buybacks. And they continue to do that, buying back 2, 3, 4% of the company year over year, just to compound total shareholder return, as they're confident that the company is going to continue to grow, earnings per share will continue to grow, and then as they lower shares, it'll just really accelerate the growth on a per share basis for the shareholder. And last but not least, VXUS. So fitting that the last stock on the US side has the same purpose as the last stock on my Canadian portfolio, but this is just an ETF that mimics the global economy excluding the US. I have lots of American stocks. So this is an ETF that owns indexes for all kinds of countries: China, Australia, Latin America, countries in the Middle East, countries in Europe, Pacific region. So I'm just getting exposure to the global economy. You can see here up 10% in the last year. I'm up about 5%, have been averaging up the last few months, even as it's gone up, just because at the end of the day, wasn't a big position. Wanted to get to at least 100 shares. And I do like how I do get, it says 4.4%, but I think it's a 3-point-something% dividend yield on an annual basis on this one. So getting paid a decent dividend to sit and have this exposure. And in addition, just with everything going on in the world right now, I don't mind like more broad exposure that one company or a handful of companies or a sector can't get absolutely slaughtered in my portfolio entirely. So at least I'll have these ETFs like ZDI, XIC, VXUS to lay back on with for that broad market exposure. Okay, so I know I ran through that one to get through it as quick as possible to make this video not too long, but hope you guys like me going through my portfolio like this. I'd love to hear from you guys in the comments if there's any stocks that you also own or you don't like that I have in my portfolio. And thank you guys again for watching. If you made it to the end of the video, be sure to give this video a big thumbs up. It really does help a lot with the YouTube algorithm. Consider subscribing to the channel, and I'll see you guys in the next one. Thanks.